Interest expense. It can be a major burden on the income statement. In this lesson, you'll learn what interest expense is, whether it's a good or bad thing, when it can be good, when it can be bad, a ratio to measure it, and what I look for when investing in companies. What is interest expense? Interest expense is the amount of interest you pay on your debt. Say you have a $100,000 loan from the bank, and the bank charges you 10% interest per annum. If you don't repay the loan, you will pay $10,000 in interest every year. 100,000 times 10% equals 10,000. This is the same for companies. If a company takes out a loan from the bank or issues bonds, they will pay interest on that debt. Interest expense is a financial expense as opposed to an operating expense. That means it is not an expense related to the running of the business, but rather an expense related to how the business is funded. It also means it comes after operating profit on the income statement. Is interest expense bad? Interest expense is not necessarily a bad thing. If I can borrow debt at a low interest rate and use that money to earn a high rate of return, then that is good. Say I borrow $100,000 at 10%, but use that money to buy another business, which earns me a 20% return. That would be a good use of debt. Interest expense becomes a bad thing when it grows so large that you can't generate enough profits to cover it. If this happens, you might be forced to sell some of your assets. If you are forced to sell some of your assets, you might not be able to make as much profit next year. That means you have less profit to pay your interest and the snowball grows until you are bankrupt. How do you know if a company is paying too much interest? I want to invest in companies that can easily cover their interest payments. A company will cover their interest payments with their operating profit. A ratio we can calculate is the interest coverage ratio. To calculate it, we simply divide operating profit by interest expense. Assume our operating profit is $100,000 and our interest expense is $10,000. That means our interest coverage ratio is 10 times. 100,000 divided by 10,000 equals 10. Is that good? Many sources will tell you that an interest coverage ratio of 2.5 times or higher is considered healthy. According to Warren Buffett and the interpretation of financial statements, Buffett likes companies that sell consumer products to have interest expenses of less than 15% of operating profit. That would equal an interest coverage ratio of around 7 times, but this varies by industry. Let's summarize. Interest expense is the interest you pay on your debt. Interest expense is a financial cost, so it comes after operating profit on the income statement. Paying interest is not a bad thing if I can earn a high return on that debt. Paying interest becomes a bad thing if I can't afford to pay it. To see if a company is paying too much interest, we can calculate the interest coverage ratio. To calculate the interest coverage ratio, we divide operating profit by interest expense. An interest coverage ratio of 2.5 times or more is considered healthy, but this varies by industry.
For more videos on investing, follow Value Theory or go to valueinvestoracademy.com.